This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. Welcome to Bloomberg Businessweek Daily on this Friday, March 6th. Carol Massar, Tim Stenivek, live here at Bloomberg headquarters. Dare we say the S word? We're talking about
you just did
stagflation. We did get that disappointing U.S. monthly jobs report, and that's happening amid a backdrop of inflationary pressures that are flamed by those higher energy prices as a result of the U.S. war in Iran. I'm looking at WTI crude, folks. It is up double-digit percentage-wise today. It's up about almost 40% for the week overall, and it's up about 60% year to date here in 2026, Tim.
Yeah, $91.53 a barrel on oil. Brent crude up over $92, close to $93. That's up another 7.5% today. That goes right to gas prices. It goes to higher input costs for companies. The
Absolutely.
Repercussions of this are just massive across the economy.
And we're trying to figure all that out for you folks. So we're going to get into, over the next 60 minutes, more on the U.S. economy as jobs do come in weaker than expected and those inflationary pressures abound. Also on that, we're going to talk, Tim, about the global energy squeeze thanks to the U.S. war in Iran. We have a great voice on that, someone who has tracked the global oil markets and energy markets for a long time.
Yeah, she literally wrote the book on Saudi Arabia and Aramco. Ellen Wald is going to be joining us a little later. Also, the private credit market woes continue again. This time, another story at the world's largest asset manager.
All right, a lot coming. It's not a quiet Friday, so a lot over the next 60 minutes, over the next 3 hours on Bloomberg Businessweek Daily. First up, though, let's get a check on that trading session. Let's toss things over to Charlie Pellet.
All right, I thank you very much. And what a Friday. Lots of moving parts, and we got you covered. We begin with where markets are right now. Dow Jones Industrial Average down 555. That is a decline now of 1.2%. Keep in mind, the Dow at one point was down 2%, down 945, recovering just a tad, down 1.2% right now. The S&P at 6754, S&P 500 index down 75, a decline of 1.1%. The NASDAQ Composite Index down 1%, with a VIX, the fear gauge, closing in right now on 27. 10-year 4.11%, the 2-year 3.52%. Gold is surging $80 the ounce, up 1.6%, 51.62. Crude, though, the major story, one we'll be covering right here on Bloomberg Businessweek Daily. WTI right around $91 a barrel, up 12.3%. We've got Brent, the global benchmark, above 93. Barrel of Brent up by 8.9%. So again, the Dow, the S&P, NASDAQ all declining. I mentioned the move in oil stocks, trading mixed right now among the oil majors. ExxonMobil up 0.7%. Chevron down 0.1%. ConocoPhillips up by about 0.7%. S&P 500 index down 1.1%. West Texas Intermediate crude up 12.5%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, so appreciate it. Charlie Pellet there. Well, U.S. employers unexpectedly cut jobs in the month of February. The unemployment rate rose, pointing to lingering fragility in a labor market that was thought to be stabilizing. Bloomberg TV and radio international economics and policy correspondent Michael McKee has been talking to a lot of Fed officials this week. He is at the Booth School Monetary Policy Forum in New York City. And earlier today, Mike caught up with Federal Reserve Bank of Chicago President Austin Goolsbee. They talked about today's labor report and a lot more.
It's a tough miss on the jobs report today. You never want to over-index on 1 month's report. And I've been consistently saying, let's not index on total payroll employment anyway, because a lot of stuff is going on with immigration, with population growth. That said, you saw the unemployment rate inching up, and it's 1 month. It's not a trend, but it's not a good month. If you got several months like that, that'd be a concerning spot for the labor market. I've been saying for some months that we've had relative steadiness in the job market, in my view. The strongest thing in the economy is not AI data center investment, has been consumer spending being solid in a kind of a broad-based way in the economy. But the inflation hasn't been ideal. It's at least stalled out at kind of 3%, and some of the latest measures, the inflation disturbingly high in non-tariff categories like services. I think we're still basically in that same spot. I remain hopeful / expecting that conditions will improve, that we'll start to see some progress on inflation, head us back to 2%, and by the end of this year, that we would be in a situation that we could commence our march back down to something like the settling point, which is below where we are today.
There you have it. Bloomberg TV and Radio international economics and policy correspondent Michael McKee earlier with Federal Reserve Bank of Chicago President Austin Goolsbee. Michael McKee joins us now from the Booth School Monetary Policy Forum in New York City. Mike, I want to go back to something that Austin Goolsbee said to you about this unemployment report, this payrolls report. He said, 1 month is not a trend, but it's not a good month if you've got several months like that. That would be concerning. A concerning spot for the labor market. If you peel back sort of the layers of this report, is this a one-off for a host of reasons, or is this the start of a bigger trend?
Well, it's hard to know, but it doesn't look good on the surface. When you look at the numbers, you look at the overall decline in jobs, a lot of it was in healthcare, which had been the only sector that was really hiring. And also, part of that was because of a strike against Kaiser Permanente out in the West Coast with nurses on strike. But even if you add them back in, healthcare hiring was very weak. So if the one driver of employment has slowed down, then you may have trouble ahead. That's the big question going forward. Is this a one-off? Is this showing that things are going to remain weak? And I think what Fed officials are saying is the labor market is weak, and some of us are worried about whether or not we should do something about it, while the inflation hawks are looking at the oil prices and saying, you know, we're hopeful that inflation will go down, but we don't know how long this war is going to last, so we don't know how long oil prices are going to remain elevated, so we've got to kind of sit on the sidelines for the moment.
All right, we want to talk more about that in a moment, but Mike, I want to get to Kevin Hassett, who spoke on Bloomberg TV earlier, of course, the White House National Economic Council Director. He said the poor February jobs report was down in part to crazy weather, though, as we noted, the number of people unable to work last month wasn't out of line with historical averages. He also said that revisions to population figures are making month-to-month changes more volatile. And so he says it's important to average things out, that this was still a strong increase in payrolls. Do you agree?
I would say that he is talking his book and trying to make things sound better than they are for the administration. Weather didn't really have anything to do with what we saw in the labor market report, and the BLS sort of points that out. 228,000 people who couldn't go to work because of weather was not substantially different from what we saw in January, and it's about what you would expect for this time of year. So that's not really an excuse. We do have the changes to the population survey, but that really isn't making a major difference in the numbers that we got this month because they split it up. We got a new population control number, but the seasonal adjustment factors and the adjustments to hiring were in the January numbers. So really, you kind of have to take this report at face value. Like I said, it may not sustain, but you really can't wave it off.
And I just want to be clear, Hassett did say, speaking on TV earlier, it's important to average things out, and there was still a strong increase in payrolls for January. You just talked about the January number. We got a lot of questions.
Yeah, it raises the question about what the Federal Reserve does on March 18th and what the Federal Reserve does at the end of April 29th, for that following meeting. Mike, does it change the picture at all?
Well, we're not sure if it changes the picture for April. That's going to really depend on what happens with the war and with energy prices and if they stay elevated. The March 18th, they're going to sit on their hands because you have a smaller minority, maybe Mickey Bowman, Chris Waller, and definitely Stephen Myron, who think that you should be cutting rates more to get ahead of the problems in the labor market. But the people who are worried about inflation have an argument that we can't really move because we don't know what's going to happen with this, and we don't want to get inflation established in the economy. We don't want inflation expectations to start to rise when people go to the gas station and see their gas prices going up quite a bit. So take that one off the table, and then let's wait and see on April. April is going to be Jay Powell's last meeting as chair. So that might argue against doing anything dramatic. But if we do see a dramatic change in the inflation picture, you could see it.
So you just got me thinking about the Warsh confirmation process. Does that mean that Warsh gets confirmed by the meeting after April 29th?
Well, we don't know. They just sent his nomination up yesterday to the Senate Banking Committee. They've got to schedule a hearing, and then there's this whole Tom Tillis not going to let anybody through while this investigation into Jay Powell is underway thing. So they've got to get that out of the way, and it isn't clear exactly how they do that. But if for some reason Kevin Warsh is not confirmed, then Powell would stay on the job as a governor, and the Open Market Committee would likely just reelect him as chairman of the Open Market Committee. They don't even really need to do that because they elected him for this whole year. So nothing would really change, but we don't have another meeting after the April meeting until later in June. So there's still a lot of time between now and then for Warsh to get confirmed and be in place for what would be his first meeting.
Hey, Mike, you've been having lots of conversations with Fed officials. Is there a common narrative or something interesting in terms of the gaps between what you're hearing? And I'm just curious, is anybody saying stagflation?
Well, Austin Goolsbee was saying stagflation, and that's been a result of previous energy crises. Now, is this a crisis? Javier Blas, our columnist, our brilliant oil columnist, was pointing out this morning that if you take a chart of oil prices and then move it out, expand the time period, you'll see that this really isn't that big a move for oil these days, that we've seen bigger moves in recent years. And so it's not a crisis yet. If it continues, then that could be a crisis. And as Tim was saying at the top of the show, oil gets into all kinds of other products. And if it gets into those products, then prices go up, then maybe economic activity slows. But at this point, it's not likely that we're going to see stagflation, but it's a danger that the Fed is going to talk about or mention just to let people know they're on the case, they're watching this.
They're on the case.
Well, we're always watching you. Great stuff, Mr. McKee, this week, and I highly recommend anybody who missed any of it, check it out. It's on the Bloomberg and at Bloomberg.com. Mike, have a great weekend. Bloomberg TV and Radio International Economics and Policy correspondent Michael McKee from the Booth School Monetary Policy Forum. And we should point out at 3:10 p.m. Wall Street time, Mike's going to actually have another interview from the event. He's going to be talking with Cleveland Fed President Beth Hammack from that forum, and we will be carrying it live on Bloomberg Radio and Bloomberg TV and on YouTube across our platforms.
Well, in the meantime, related absolutely to the Fed, let's stay on the labor market. Back with us is Karin Kimbrough, chief economist at LinkedIn. Karin joins us from Sunnyvale, California. Karin, good to have you back with us. You were managing director and head of macro policy at Bank of America. You were vice president of the markets group at the Fed in New York during the financial crisis. So you've seen your share of cycles and macroeconomic events. That said, in the context of what we got today from the Payrolls report, and in the context of this new conflict with the U.S. and Israel and Iran, what does that do for the labor market?
Yeah, so I'm going to confine my remarks to the labor market, which is what I've been focused on right now. And I think where we are right now is at a place where obviously the labor market is been cooling for a couple of years. We've seen it in our data here at LinkedIn with a very sluggish hiring rate. It has not picked up. The hiring rate is running, 20% slower than in 2019, 7% slower than last year. And that's just the US. So I think where we are is a place where policymakers for monetary policy need to consider all of the forces. They've got, obviously, to consider the oil prices you just mentioned, which are an inflationary push, but they also need to consider what the everyday worker is looking at. And here's what I would leave you with. I think as long as workers feel like they can find a job and get a steady income, they will continue to spend. But if they don't, then you have concerns around whether the K-shaped economy is really taking root and going to pose a problem down the road.
Can you say those numbers again? You said 7% lower in terms of hiring rate than last year. That's in the U.S. And what was the other number?
So yes, the hiring rate in the US is running 7% slower than a year ago and running over 20% slower than in 2019. So pre-pandemic baseline, when things were looking pretty good and pretty stable, we were hiring a lot faster. And what that really means is just there was a lot more turnover and churn and moving around in the markets. Think about where we were in 2021 when you had a lot of people getting hired and changing jobs. This is the inverse. People are staying put. We see it in our data. One of the most interesting things I see is the fact that there are actually fewer job applications per applicant on our platform in the last couple of months. And what that suggests to us is that people are getting a little bit fatigued out. They're a little bit discouraged. Wow. And you also see it in the government data where you've got people staying in unemployment for longer and longer periods of time. I think it's 25%. Now, the unemployed have been unemployed for nearly 7 months.
It's a long time.
So people are getting a little discouraged. And I think that's one of the more interesting signals coming from our data. Hey,
Karin, Tim mentioned your background. I mean, you were VP in the markets group of the Federal Bank of New York during the financial crisis. We've had some prominent names, whether it's Jamie Dimon and some others who remember the financial crisis so well, being there, leading banks during that. Is there anything that what you are seeing in terms of labor data that says to you that we are headed towards some kind of crisis or some kind of recession or something more significant than a word that we're using currently today?
Right. Yeah. So look, this is how I think about it. You have the macro data. This is the GDP, how quickly the economy is running. And that is, that's going to tell us GDP growth and inflation. And so far that hasn't looked too bad over the last few quarters. I think if you average it out, it's been running around 2%. We'll see what it comes in for this current quarter. And then you've got the jobs market, which is a totally different story. That really means very little job growth. By our own data, we're seeing something like, 15,000 jobs being created a month on average, if you smooth out across a year. So it's really low. And so I think what's happening is we're having sort of a jobless growth in our economy right now. That doesn't speak to me as a crisis. What would be a crisis? And I don't think we're there yet at all. Let me be really clear. I think that labor market is pretty stable. It's just running in first gear as opposed to fifth gear. What would be concerning would be if the consumer didn't feel confident about their ability to find and get a job, and then they, as a result, stop spending. I think that would be the transmission effect or the shock that you'd be looking for. But right now, for the moment, the consumer is sort of holding in, and I think we have our fingers crossed that will continue despite the most recent pickups, in geopolitical tension.
What's the data point that we should look at to understand if the consumer is going to pull back? That would be like a sort of a preview or an indication that, hey, this might happen. You should pay attention to this.
Look, I spend my time mainly looking at the labor market. So I'm looking a lot at things like the unemployment rate, just generally across different cohorts, whether you have a graduate degree or you have an associate's degree, whether you are, living in a certain region in the US or working in a certain industry. But I think overall, it would be looking to see how people are doing with their credit. Are they running behind in terms of running up credit, being unable to pay, delinquencies, things like that are sort of the canary in the coal mine for whether consumers are starting to be under stress. What I will say now is that the job market's okay. People who have a job, you're doing just fine. If you don't, it's a bit of a challenge.
Okay, that makes sense, certainly based on the data that you and the government see. Karin Kimbrough, Chief Economist at LinkedIn. Reminder, coming up at 3:10 p.m. Wall Street time, Mike McKee talking with Cleveland Fed President Beth Hammack, and we will carry that live on Bloomberg Radio and TV. Coming up next, we've got to talk about the energy markets.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a down day for the U.S. stock market. We're heading for a down week as well. The Dow, the S&P, NASDAQ, they're all in the red, right to the numbers here. Jobs Friday, but also a focus on oil and inflation. The S&P right now down 1%, as is the Dow. The S&P down 70 to 6760. Dow Industrials down 480 right now. At one point, the Dow was down 945 points. The NASDAQ Composite Index down down 1%. The Nasdaq 100 index also down 1%, with the VIX, the fear gauge, at 26. The 10-year 4.11%. Spot gold up 1.7%, 51.67 a barrel. West Texas Intermediate crude now below 91, 90.76. WTI surging today by 12%. This on a widening war in the Middle East that is lifting oil prices. Brent, the global benchmark, up now by 8.6%. Barrel of Brent crude 92.77, but that WTI quote bears repeating. Right now, it is up by 12.3%. Sources tell Bloomberg Boeing is closing in on one of the largest sales in its history, a 500 aircraft order for 737 MAX jets set to be unveiled when President Trump travels to Beijing for his first-day visit to China since 2017. Boeing shares up now by 3.9%. Recapping a drop of 1% on the S&P 500 index, the 10-year 4.11%, West Texas Intermediate crude up 12.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, got it. Thank you so much. Charlie's setting us up, as he always does, so well in terms of the energy markets. Of course, that widening conflict in the Middle East is stoking fears over a global energy crunch. You've got exporters scrambling for routes out of the region while a swath of refineries are reducing output. This is certainly some of the big stories that are going on here.
The near halt of traffic through the Strait of Hormuz is causing storage tanks across the region to top out. Drone and missile attacks have targeted refineries in Saudi Arabia, Kuwait, and Bahrain. The escalating war has choked off oil and gas supplies to key customers in Asia and Europe and sent energy prices soaring.
Charlie mentioned it. We've got WTI almost up 40% so far this week, 60% year to date. You've been talking about Brent crude, same story. We are just seeing the global energy picture in terms of prices move up. So we've got a great voice joining us once again. Dr. Ellen Wald is president of Transversal Consulting and senior fellow at the Atlantic Council. She's also author of Saudi Inc., understands the region so much. She joins us once again from Boca Raton, Florida. Ellen, big picture first, a lot coming at us. We're trying to figure out, and I think a lot of it has to do with how long this war goes on. But short term, long term, how are you thinking about the global energy markets?
I would say both short term and I think short term, we are right on the precipice of what could be a global energy crisis. If we don't get traffic moving through the Strait of Hormuz soon, and even at a reduced rate would be fine. But we've got to get some sort of movement going. If we don't see that by the end of next week, I would say that we're looking at shortages across Asia and all sorts of other dislocations that are going to happen simply because you've got tons of tankers just sitting there. Okay. You've got storage facilities filling up to the point where producers in the Middle East are already having to cut production, and yet that oil is desperately needed everywhere else, particularly in Asia and then Europe. We've already got a crisis in natural gas prices in Europe simply because Qatar has shut down natural gas production. And that's not something that can be turned on immediately. That's going to take a while to restart, even if the hostilities ended tomorrow. And I think that the world is really waiting to hear from the Trump administration, what are their plans to alleviate this crisis, because it doesn't have to get as bad as it could get. There are steps and things that we can do right now to start alleviating this crisis.
Ellen, like what, for example? Does it mean reinsurance for ships that are in the region to provide at least confidence to the folks who are at the shipping companies that, okay, your investments will be protected? What could the Trump administration do?
I mean, that's I would say that's like the tip of the iceberg.
Okay.
We need to see some concerted military effort to protect ships. Now, I understand that's very difficult when the primary issue here are drones that are flying, and it's really hard to protect against that. But there's got to be some kind of military presence protecting tankers. There are other things that can be done. They can reroute ships out of the current traffic scheme that takes them right through Iranian waters to a shipping route that's farther south that used to be used in, before 1979 that might take them somewhat away from the Iranian shoreline. They can make efforts to, and I said this recently in a piece for Atlantic Council, to remove the Iranian military presence from certain islands in the Strait of Hormuz that ships have to pass by in order to get out. If they can, if our military can remove Iranian troops from those islands, and there's a much better chance in ships having actual safe passage. And then there's just this issue of these drones flying everywhere that are now starting to hit oil production, oil facilities, oil infrastructure across the Middle East. There was an oil field in Iraq that was hit recently. You've got refineries that are being hit. These are the kinds of things that can't necessarily be repaired quickly and that are also jacking up oil prices in addition to this tanker crisis.
Well, it's interesting. We've been thinking about history as a guide or not as a guide, Ellen, and we were talking with a guest about the energy crisis during the 70s, right? When there were lines in the United States and odd and even license plates. We brought
that up with Steve Moore.
Exactly.
This week.
And we've talked about, early 90s, right? The Persian Gulf War and what we saw in terms of energy prices. You've got, it's fair to say, you now have the U.S. that's kind of has energy independence. You've got alternative energy at play. So what's similar? What can we lean on in terms of history? What can we not?
So I think that the U.S., I wouldn't say we're energy independent, but I would say that we are particularly isolated from some of these issues that other countries are going to face much sooner than us. Some countries have ample storage. China's got a lot of oil in storage, but other countries don't. And so they're going to start to feel the effects first. It's interesting. These are the two historical examples that were pulled. I would actually look a little bit farther back to the Suez crisis in the 1950s. And actually, before Britain and France went and invaded the Suez Canal to try to take it back from Nasser, they and the United States, all three of them, coordinated plans for what to do in the event that there was an energy crisis involving the Suez Canal. And there were actually all sorts of plans put in place for which ships would go where and how Europe would be supplied with oil in the event that they couldn't get it through the Suez Canal. And the fact that we didn't put these plans in place, we didn't even reach out to communicate to the people who might be most affected by this, I think is a serious problem, and we should be correcting that. We should be looking at this example, establishing coordinating committees, talking to these Asian countries and seeing what can be arranged so that we can make these oil shortages that they might suffer less, particularly if this military confrontation is going to last for 6 months now. Just earlier we were hearing 4 weeks and now we're hearing 6 months. So, there are things that we can do to help. And I think that we're not necessarily doing them.
We're speaking with Dr. Ellen Wald. She's president of Transversal Consulting. She's senior fellow at the Atlantic Council. She's the author of Saudi Inc., about Aramco and the country of Saudi Arabia. I bring that up right now because a story just crossing our Bloomberg terminal. This is a Bloomberg exclusive about how Saudi Arabia has stepped up direct engagement with Iran to try and contain a war in the Middle East that's wreaking havoc and stressing global markets. This is according to several European officials. Bloomberg News is the first to report on these Saudi efforts. You know the country of Saudi Arabia very well. You understand how inextricably bound it is to Aramco and the oil industry. As the price of oil goes up, that's a good thing for the Kingdom of Saudi Arabia. So there is this, it's an awkward question to ask, but there are these sort of competing tensions here when it comes to Saudi Arabia and its role in ending this conflict.
Well, let's remember, it's only a good thing for Aramco if they can actually sell oil. If they can't actually sell any oil at, $91 a barrel,
it's just sitting there and it's at risk. Yeah.
Now, Aramco is actually in a very unique situation, and they have the ability to send oil out to their port in Yanbu, which is on the Red Sea. And they can send about 7 million barrels a day that way. And so they have that ability. They're using that ability. They also have oil stored all over the place, and that they can utilize at least to avert, energy shortages, or they can fulfill their customer orders from that for a period of time. Then they'll obviously have to refill their storage. they could make a lot more money if they could sell more than 7 million barrels a day, but they can't get it out of the Persian Gulf. So it's kind of interesting. I do think that the real winners here are Russia and the U.S. oil industry. If the U.S. oil industry, or at least some parts of the U.S. oil industry, could put more rigs into production and produce more oil and sell more oil, they could certainly make money off of this. And Russia is, of course, making a lot of money as well.
Well, do we see U.S. producers kind of kick into high gear over this, or not so fast?
So this is the interesting question, because initially I think they're very wary of of putting in more capital, of doing this, because they've been burned before. And so I think that, if they were receiving some kind of guidance from the Trump administration, some kind of thoughts on what would be helpful, they might be likely to put more investment in to produce more, if they had a sense that, okay, yes, this is going to be valuable over the next several months, as opposed to, well, the conflict could be over in 5 days, and then, we've just wasted our time and money.
Hey, one thing I wanted to ask you, for some reason, because I have my dumb moments, is China and energy. I know that they are reliant so much on the global energy markets, but I had no idea all the refining that goes on there, because I know that they specifically, the Chinese government, I think this was earlier this week, has told the country's top oil refiners to suspend exports of diesel and gasoline. I didn't know that they were the third largest supplier of oil products into the region. So I do think about where the pressure comes maybe from the U.S. to kind of put an end to this, because how much does China get hurt in all of this?
Well, exactly. I mean, China gets huge amounts of oil and products from the Middle East. They're also, by the way, invested in refineries and in petrochemical facilities in Saudi Arabia. So they may be losing money in that there also. But yeah, China is saying, hey, we need to conserve this for domestic use, because we can't necessarily depend on these, imports that we may have been getting from the Middle East. So we're not going to be selling to the region. And now they're leaving, they're leaving other Asian customers there high and dry. And they're saying, well, we used to get this diesel, from these refiners in China. Now where are we going to get it? We can't get it from the Middle East. And I think there's a whole lot of dislocation that's happening now. And I do believe the market will sort it out. Okay. People will have to pay higher prices. But there's also this element of we're missing a huge amount of supply right now.
Hey, Ellen, we only have 20 seconds left. We started the conversation out. You said if things don't get cleared up by the end of next week, then we'll face a full-blown crisis. What does that mean for oil prices? Just 20 seconds.
Triple digits.
Triple digits.
Like how far? Do we go back up to 140?
I definitely think 120 is possible. I mean, we're already at 92. So if nothing moves, then we could definitely see 100, I would say, by early next week.
All right. Ellen, thank you so much. Good to have you back here. Dr. Ellen Wald, president of Transversal Consulting, senior fellow at the Atlantic Council, author of Saudi Inc. As we head to a break, you're looking at New York crude, folks, up almost 12%. Brent crude, a gain of 8%. We are up almost 40% on the week overall.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, all in the red, off session lows. At one point, the S&P 500 index was down 119 points, down 1.7%. Right now, looking at a loss of 69 points on the S&P. That is a drop of 1%. The Dow Industrials also down by 1%. NASDAQ Composite Index down 1.1%. The VIX, the fear gauge, at 26. The 10-year, 4.11%. Spot gold is up $78 the ounce to $51.60, up 1.5%. West Texas Intermediate crude, big story today, holding just below $91 a barrel. WTI up right now by 12.1%, and Bitcoin now down 4.1%, 68,235 on Bitcoin. A weak jobs report hitting stocks at a time when that widening war in the Middle East is lifting oil prices and fueling inflation jitters. Again, the S&P down 1%, West Texas Intermediate crude up 12% at $90.77 a barrel. Marvell Technology shares are core surging 20.4% after the chipmaker delivered a bullish sales outlook. Oracle, meanwhile, said to be planning to axe thousands of jobs among its moves to handle a cash crunch from a massive AI data center expansion effort. Oracle up today by 2.6%. S&P 500 index down 1%. West Texas Intermediate crude oil up 12.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. Well, yes, the U.S. war in Iran was the top concern, I think it's safe to say, in the trade this week, although markets seem to kind of take a lot of it in stride. Yeah. There has also been continued concerns when it comes to private credit. A few stories we just want to point out today, including how some 146 companies in Europe have ceded control to direct lending funds after they could no longer afford to pay their debts. That's according to Goldman Sachs.
And I'm looking at shares at BlackRock down 6.5%. The world's largest asset manager, that company curbing withdrawals from its $26 billion private credit fund.
And then we've got Blue Owl, of course, the U.S. private credit firm. That firm has a $48 million exposure to Century Capital Partners. That's that London-based property lender that filed for administration last month. We've been following that one as well.
Yeah, Blue Owl shares down just a little over 3% as we speak. The private credit hits keep on coming. Today. Just look at the longer term chart for a fuller picture. With an update, back with us is Bloomberg News senior editor for credit, James Crombie, joins us here in the studio. James is also the host of the Credit Edge podcast by Bloomberg Intelligence. So it's not clear sort of where to begin. We actually had to erase some of the stories we were going to mention because it would have just taken too much time to update everybody on everything happening just in the last 24 hours with concerns around private credit. What's the main concern to you?
Well, private credit is experiencing its Roach Motel moment in terms of retail getting spooked. Retail is really worried. Retail is trying to take out more money than you're allowed to take out. But I would say also look at the prospectus. You know, the BlackRock prospectus for the fund that is being redeemed right now. It says on page 1, 5%, and it's up to them whether they even do that. So you should read the paperwork. The problem with credit and a lot of markets over the last 5 years or so of easy money is people just haven't been doing that work.
So do people ever do that work?
Well,
it's on page 1.
But shame on you. I mean, this is one of the things that we always talk about when we talk about private credit. And I've had terminal users like, do people understand what private credit, how this market works? That's an understanding. It's not liquid, right?
It's not liquid. These are long-term investments in direct loans, which, you sign a contract, you agree to lend the company money for, let's say, 5 years, and you get it back after 5 years, plus a premium. Plus, I'll tell you, investment grade bonds right now, 5%. I'm going to offer you something else for 3 times that.
Right.
What do you have to do for me to get that extra return? Read page 1 of the prospectus. You're going to have to lock your money up, and there will be a penalty, and you probably won't be able to get your money back when you want it.
James, there's locking your money up, and then there's problems. So how do you distinguish between what we are seeing is that it's just not the right market environment yet for private credit, and so it's going to maybe take longer for either the exits, for the returns, and so investors, you got to understand that. Or is there problems somewhere within the lending and the whole process? Like, how do we, and that maybe people are investing, these firms are actually investing in things that aren't so great, and that transparency isn't truly there for investors.
There are certainly problems on the software side, which we're now starting to see. A lot of these loans were made 5 years ago when rates were 0 and the money was flowing and people weren't asking too many questions and leverage was going on pretty high. Now those things are coming up for refinancing. Those companies are in a much more difficult situation. Some of them may be completely replaced by AI, so you're not going to get your money back. We did see BlackRock write off a loan, $25 million in a kind of Amazon adjacent space. That's $25 million for a very large fund.
Right. The point we made yesterday, not a lot of money for a company like BlackRock, but for, it sounds still $25 million, $25 million.
But it's BlackRock.
And it's going to 0.
The world's largest asset manager. Yes. Like there's, to be fair, you put firms in a certain category, and we do that, rightfully so. And so you're like, well, if they missed it, or does every great investor, Warren Buffett would probably say, I've missed some things, right? Like, how do you assess that?
I mean, there's a lot of pick your manager, get the right manager, don't be a tourist, all these things. Use someone specialized. But you're right, when it's BlackRock losing money, then you start to be concerned. But, again, I point to the returns. The returns expectations were very high. sometimes as high as 20%. So, you've got to assume a bit of a loss there along the way. You're going to take some risk. So I think, the whole outcome, the upshot for me would be, on the one hand, curb your enthusiasm about private credit returns. They're not going to be 20%. They may be closer to, less than 10. On the other hand, curb your enthusiasm about the growth of this market because it all relies on retail money piling in and getting you to 40 trillion from 2 trillion currently. I just don't think that's going to happen.
Well, to that point, shares of Blue Owl are down more than 60% from the highs just about a year ago on January 24th, 2025. James, I think the question that people have, and this is literally the $2 trillion question, is about contagion and about to what extent, since you and I, we last spoke to you 2 weeks ago. Since you were last on our program, have fears about contagion, this spreading to other asset classes, this spreading to big banks, has that shifted?
We're seeing more definitely shorts on the BDCs. We're seeing shorts on the credit market as a whole in terms of the CDX, which is the CDS index, which is a liquid way to take a position if you wanted to. We're seeing outflows from some of the ETFs that are related. So there is a fear that starts to feed on itself. That when you start getting big redemptions, then you have to sell not necessarily the bad stuff, but the good stuff to get liquidity, and that results in just a bit of a downward spiral.
I just want to go to BDCs. It's certainly something we've talked about a lot here at Bloomberg for years. The business development companies, where are they when it comes to the private credit market? Like, how much of private credit are BDCs?
Well, it's a big proportion of it, but they are the only visible side of it. That's why we look at them, because they actually
some transparency.
There is a bit of transparency there, and it's a growing part of the market. Maybe that growth starts to slow because of what we're seeing right now, but it is a big. If you wanted to get into private credit, that is a decent channel to do it.
How do you suss out if whether or not this is going to be? I mean, a lot of financial crises are credit-based, so this is why it's got everybody, their hairs on their neck kind of standing up. So how do you guys suss it out, or like what are you watching, as it feels like every day there are several stories?
I mean, to me, it's an orderly sell-off. It's a repricing of a market that got very, very expensive.
Okay.
Credit has been overpriced for a long time, and now it's slightly cheaper, but every time it gets cheaper, people buy into it. People buy that dip. They get very well rewarded for doing that. So there is a lot of cash on the sidelines that wants, 7% yield in a junk bond, because, that's a good coupon to get, especially if rates continue to go down. We just don't know that at this point.
Right.
If
rates go up, will there be more pressure points, more stress?
It will certainly stress out the weak borrowers with a lot of debt coming due because they can't cover those bills. On the other side, it may make private credit even more attractive because that is a floating rate asset. So there's going to be a push to floating. So there are lots of, I think, ramifications, lots of we don't know yet.
Yeah.
Well, sorry, we just have 20 seconds left, but I wonder at the end of the day if when this passes, if sort of a stronger product emerges on the other side.
That would be the hope, that it grows up and people actually read.
This is a maturing moment.
People actually read page 1 of the prospectus.
You've said that so many times.
But it's something
I guess
to
we
think
got to
about, right?
Print.
As we look to expand the market, right?
Read the small print. Know what you're doing and why you're getting paid more to do it.
Right. Risk reward, folks. That's how it works. Bloomberg News Senior Editor of Credit, James Crombie. Hey, as we head to a break, a look at some of the names in the private credit space, including Blue Owl, BlackRock, Apollo Global, Blackstone. You can see all of them. Blue Owl down 4%, BlackRock down about 7%, Apollo down about almost 2%, and Blackstone down about 4%. Stick around, everybody. This is Bloomberg.